and welcome back to the course on Forex trading. In today's tutorial we will be talking about pip value. Now we already know what a pip is. It represents a unit of change in the quotation of a currency. Pip value will allow us to translate pips into dollars. It will help us understand how a certain number of pips means a certain amount of profit on our account. It will allow us to calculate these profits, losses, and ultimately Forex risks. So as you can imagine, today's tutorial and the next tutorial are very important for us to continue and with this course and proceed to live real trading. So to start with, let's imagine an example. Let's imagine that we entered into a trade and the market has moved a certain number of pips, which is represented by the pips variable here on the left. Also, we know that we had a specific volume of our transaction, which is represented by the lots variable on the right. So together, these two variables combined will determine pip value for this transaction. So this is important to understand, that pip value is not just a function of the currency pair that you're looking at. Pip value depends on the number of pips the currency pair has moved and also on the volume of your transaction. So if you enter into transaction with a higher number of lots, then your pip value will be higher. If you enter with a lower number of lots, your pip value will be lower. Let's have a look at this in a basic conceptual example. So here we have the euro-dollar chart on the right. The price is 1.23228. Price moves up a bit and goes to 1.23478. That's approximately a movement of 25 pips. So now let's imagine that we had entered into the market with a buy order at the lower level and exited the market at the higher level. So if our buy order had a volume of 0.1 lots, then we got a certain amount of profit from this transaction. If our buy order was 1.0 lots, then we got much more profit. In fact, 10 times more profit from this transaction. If our buy order was 5 lots, then we got even more profit from this transaction. 50 times more than in the original case. So that is exactly what we mean when we say that pip value is both a function of how much the currency pair has moved and how much you have invested into this particular trade. Those are the basic concepts around pip value. And if you understand that, then that will be well and truly enough for you to grasp the concepts of live real trading. What we're going to do now in this tutorial is we're going to look at this particular example of the euro-dollar in more detail and actually go through the calculations that will tell us how to translate pips into dollars. And then we will proceed further to derive a general formula for pip value. So if you don't want to get into the mathematics, then by all means skip the rest of this tutorial and move on to the next one. At the beginning of the next tutorial, I will bring up the result that we'll get in the current tutorial, and you'll be able to just move forward with the result. However, if you do want to participate in the maths, then feel free to stick around. We're going to dive into it right now. So let's look at this example that we talked about just now in more detail. There's our chart on the right. The price moved up 25 pips. So let's calculate the value of the euros that we bought at the moment when we entered into the transaction. The value of the euros that we bought is calculated as the number of lots times 100,000 units of base currency times the price at 0.1. So if we replace those, that'll be 1 lot. We'll look at an example where we bought 1 lot. So 1 lot times 100,000 euros times 1.23228 dollars per euro. And that gives us $123,228. Now let's calculate the value at 0.2 at the top. Value at 0.2 is calculated in a very similar fashion. 1 lot times 100,000 euros times 1.23478 dollars per euro. So here we're using the new price. and the new value is $123,478. Now let's calculate the change in value. The change in value is equal to value 2 minus value 1, and in this case it's $250. And obviously the pip value is going to be equal to the change in value divided by the change in pips. And in our case, it's $250 divided by 25 pips because, as you can recall, the price moved up by 25 pips. And that gives us a pip value of $10 per pip. That was quite simple and straightforward. All we had to do was take the difference in values, which we calculate separately, and divide by the difference in pips. Now let's look at a general form of this calculation. So to start off with, we calculate the change, which is value 2 minus value 1. Value 2 is lots times 100,000 units of base currency times price 2. Value 1 is lots times 100,000 units of base currency times price 1. We can bring in the brackets and leave price 2 minus price 1 within the brackets and take lots times 100,000 units of base currency outside of the brackets. Next, we can replace price 2 minus price 1 with delta pips. And we know that regardless of whether we're using a 4-digit or 5-digit broker, pips is always 0.0001. So here we're replacing price 2 minus price 1 with delta pips times 0.0001. And next, we get rid of the 100,000 times 0.0001, which gives us 10. So the change in value is always equal to lots times 10 times delta pips and is measured in the units of quoted currency. So now if we proceed to calculate pip value, we need to take the change and divide it by the number of pips that the currency has moved. So if we plug in the previous result into this formula, we'll get lots times 10 times delta pips divided by delta pips. And if we simplify this formula even further, we'll get lots times 10. So this gives us a result that pip value is always equal to lots times 10 and is measured in units of quoted currency. So this is a very important formula to remember, and we'll talk about it further in the next tutorial. Calculating risk. So this tutorial flows on directly from the previous one, and if you skip the mathematics at the end of the previous tutorial, then not a worry, because right now I will show you the result that we got in the previous tutorial and we'll pick up from there. So the result that we got was that pip value is always equal to lots times 10 and is measured in units of quoted currency. What this means is that if your currency moves a certain number of pips and you have a transaction in the market at the time which has a volume of equal to lots, where lots is the variable in our equation, then the value of every single pip will be equal to the number of lots in your transaction times 10, and it will be measured in units of quoted currency. So if you're trading the euro dollar and you're in the market with one lot, then every time the currency moves 1 pip in your favor, you're earning 1 times 10 equals to 10 units of quoted currency, and in this case the quoted currency is dollars. So every time the currency moves in your favor, you're earning $10. If you're in the market with a transaction with a volume of 10 lots, then every time the currency moves in your favor, you're earning $100. So that's a very simple concept, and this is a very powerful formula for you to remember and for you to use in your trading. You can always very quickly look at the chart, look at the number of lots that a trader is currently in the market with, and you can very quickly say how much he's earning or losing at every single movement of the currency. And let's remember here, this is pip value, so not points but pips, and it's not going to change whether it's a 4-digit or 5-digit broker. It's always 0.0001. Okay, so now we're going to create an even more powerful formula out of this, and it'll be very simple. We're going to create a formula to calculate our risks on the Forex market. So let's look at a very intuitive formula. This red formula is very straightforward and easy to understand. So the risk, which is on the left, or the amount of money that we can lose in one transaction on the Forex market, is equal to the stop loss measured in pips. So for example, it's 50 pips that you have a stop loss, times the pip value, so the amount of money you lose per every pip. So for example, it's like in our previous case, $10 per pip. So if your stop loss is 50 pips and pip value is equal to $10 per pip, then you can potentially lose $500 on this transaction if your stop loss is triggered. And that means, in Forex, that means that your risk is equal to $500. So basically in this case, risk is the maximum amount of money you can lose on this particular transaction. And let's remember here that this is all still in the units of quoted currency. So that is a very simple formula that does not require derivation because it's just intuitive. Now, how about we put these two formulas together? We know that pip value is lots times 10, and we also know that risk is stop loss in pips times pip value. So let's take pip value from the first formula and plug it into the second one. Let's see what we get. We get risk is equal to stop loss in pips times lots times 10. That's quite interesting, isn't it? And now let's take it a step forward. Let's, from this formula, derive what our lots would equal to if we know risk and stop loss in pips. In that case, lots is equal to risk divided by the stop loss in pips times 10. And all of this is measured in, well, risk in this case is measured in units of quoted currency. So this is a formula that I'd like to stop our attention on, or draw our attention to, because this is a very, very important formula that we will be using throughout our live Forex trading in the further tutorials. What this formula tells us is if we know how much we can risk on a particular transaction, we know that we have a certain level of confidence in the market, in our signals, in our decision to buy or sell, and we know that in this particular transaction we would like, we're prepared to risk, say for instance, $50. And we also know where we want to set our stop loss. We know that based on our signals, our stop loss has to be set at this certain level. Then from that, we can derive the amount of lots that we have to enter the market with. So all you have to do is you take your risk, the amount of money that you're prepared to lose in a particular transaction if the market goes against you, and you divide that by the number of number of pips in your stop loss, multiplied by 10, and that will give you the amount of lots you should enter the market with. And that's very powerful because that's the way you control your risks. It's wrong when a trader first thinks, oh, I'm going to enter the market with 1 lot or 10 lots or 0.5 lots. You can't possibly think that way. You should always first think how much you're prepared to lose if the market does go against you, and that should be a function of your confidence in your trade, confidence in your signals, whether you're trading with the trend or against the trend, and so on. And then you have to also know where your trading system is telling you to set your stop loss, and that's the exact order in which these things done. A lot of traders get it wrong, and they first think, oh, I'll trade with this amount of lots, and where should I set my stop loss? No, you should first think of how much you're willing to lose if everything goes against you, then where you're setting your stop loss, and then you'll get your lots using this formula. Now, an important thing to remember is that risk in this case is calculated in units of quoted currency. So in a lot of cases when the American dollar is the quoted currency and your account is in American dollars, then the quoted currency will be the currency on your account and will be American dollars. But if you're trading a currency pair where the quoted currency is not American dollars, remember that you also have to convert your thinking. You have to convert you'll be thinking of how much you're prepared to lose in your account balance currency, which is most likely American dollars. And then you'll need to convert that to the quoted currency and then plug it into the formula. I do have to admit that sometimes I forget it myself, and further down in these tutorials you'll notice that when we're trading the Australian dollar, Canadian dollar, I did make that mistake and I didn't convert American dollars into Canadian dollars before plugging into the formula. So maybe you can pick up on that mistake and see what the proper calculation should have been. But it didn't make that much of a difference in that particular case because the Canadian dollar and American dollar are currently quite close in terms of price. However, do remember this for future, and when you use this formula, make sure risk is entered in units of the quoted currency. So that's it for today's tutorial. Next time we're going to plunge in straight into live trading on a real account. I hope you're super excited because I definitely am. And I look forward to seeing you then. Until next time, happy trading.